Happy New Year to all of my students, both old and newcomers, and to those who are in our Discord group. As we embark on a new week, financial markets are preparing for a flurry of economic data and events that hold the promise of influencing the trajectories of global currencies and markets. Key focal points include the highly anticipated NFP report and Eurozone CPI on Friday, along with additional scrutiny on the FOMC minutes, ISM PMIs, Canadian employment figures, and Chinese PMIs. Brace yourselves for a week potentially filled with market-altering revelations. The narrative surrounding the US dollar in 2023 mirrors a roller coaster ride, characterized by fluctuating hopes of a Federal Reserve pivot. Expectations were repeatedly tempered by surprisingly robust economic data, primarily stemming from the resilient performance of the American labor market. Despite a robust rebound during the summer and autumn, the greenback seems poised to conclude the year with losses approaching 3% against a basket of currencies. The catalyst for the dollar's rebound was a surge in Treasury yields that took center stage, propelling the rally. However, market optimism has been moderated by heightened expectations of aggressive rate cuts in 2024. Confident yields were too optimistic to sustain, and they cannot be justified solely by economic strength as signs of weakening inflation become evident. As Q4 approaches, a series of weaker economic data has shifted the narrative against those betting on the Fed's commitment to a higher-for-longer interest rate policy. As Treasury yields crumble, the dollar takes a significant hit in response to this evolving narrative. Scene script. Currently, cumulative rate cut odds are hurtling towards an astonishing 160 basis points, a figure that raises eyebrows given the non-recessionary state of the U.S. economy. Approaching the release of the December meeting minutes, the Federal Open Market Committee, FOMC, may seize the opportunity to reiterate a vision of only modest policy easing over the next few years. Dollar sellers are holding on to overly priced rate cuts, positing that every Fed meeting after January will witness a 25 BPS reduction. This aggressive stance seems to require a recession to force the Fed into such action. However, with the current relatively robust U.S. economy, such pricing is challenging to rationalize. A more conservative view suggests the Fed may cut rates only 3-4 times next year. The key determinant between the two narratives lies in how the U.S. economy unfolds. Stronger economic data may prompt a reduction in rate cut expectations, perhaps lesser than the current projections, while a weakening economy may align with the current aggressive pricing for rate cuts. A pivotal aspect of the rate path is policymakers' outlook on the jobs market. Recent indications from the Fed suggest that as inflation subsides, their focus on the other mandate, employment, will intensify. Federal Reserve Chief Powell has dropped subtle hints about an impending pivot. The upcoming non-farm payrolls (NFP) report for December is projected to rise by 158K, a slight dip from November's figure. The jobless rate is expected to tick up slightly to 3.8%, while average earnings are anticipated to maintain a steady pace. Despite the market's strong conviction that the Fed is on the brink of slashing rates, a minor beat or miss in the jobs report may trigger only a fleeting reaction in the dollar. The real shock could stem from an unexpectedly strong report, prompting the dollar and yields to surge. Wall Street might witness panic selling as investors scale back rate cut bets based on upbeat NFP readings. If the jobs data fails to provide a fresh market direction, attention is likely to shift to other releases throughout the week. These include the ISM manufacturing and non-manufacturing PMIs, JOLTS job openings, challenger layoffs, and factory orders. Each data point will contribute to the market narrative and could potentially sway investor sentiment. Turning our focus to the Canadian dollar, the loonie remains vigilant over its domestic labor market. Recent increases in rate cut bets for the Bank of Canada add a layer of complexity to its 2023 performance. While the Canadian dollar has outpaced its commodity-linked counterparts, the Australian and New Zealand dollars, in gaining about 2.5% against the US dollar, challenges loom on the horizon. Looking ahead to 2024, there's a looming risk that economic stagnation may force the Bank of Canada into a rate-cutting stance. The country's unemployment rate, steadily increasing since May, is expected to rise further in December to 5.9%. This upcoming data release on Friday could provide a critical snapshot of the challenges the loonie may face in the coming year. Don't put excessive emphasis on the rate cut narrative, as it's already factored into the market. The critical question now is whether upcoming data will align with those expectations. Any reduction in the current rate expectations will strengthen the USD and potentially roll back some bets favoring anti-dollar currencies. Economic differentials, including employment, wages, and other leading indicators, will play a pivotal role, overshadowing the significance of the CPI report. Consequently, this data will determine whether a modest rate cut suffices or if a more substantial adjustment is required to accommodate the economy.